Hello, everybody. Welcome to our second panel of this year's Investment Management Regulatory University. This is Stephanie Monaco speaking, and I want to express our thanks that you're able to deal with the COVID consequences of a remote seminar. This year, as I mentioned in our first panel last week, we will be having a different panel each Wednesday in September beginning at noon Eastern. Today we are going to have a panel led by my dear colleague Leslie Cruz that will cover GDPR, ESG, U.S. privacy, cyber, and LIBOR. Next week we're going to be having a panel entitled Steering the Course for Growth of Global Asset Management Products. That is our ever popular fund development panel. The week after that will be our enforcement panel where we will talk about DOJ's interest in money managers, key enforcement trends, issues associated with remote working, stimulus fraud, very interesting topics. And then lastly, on September 30th will be our ethics panel where we are attempting to get an ethics CLE credit for it. It is applied, but it's unclear at this point if we will get the ethics CLE credit, but that will be a very interesting panel also talking about congressional and executive branch investigations and subpoenas, as well as internal investigations that can go wrong and how to engage in the best practices to avoid that. Some housekeeping notes before I turn this over to Leslie. If you wish to ask questions, you click on the Q&A widget on your screen down at the bottom. We do answer questions throughout the webinar, so don't be shy. There is no such thing as a stupid question. Please avail yourselves of the Q&A widget. For those seeking CLE credits today, you need to download the affirmation form and the evaluation form found in the resources widget on the screen. We will announce the CLE code once during the middle of the presentation, and to ensure that you can stay on and do stay on for the entire hour, again at the end. Please return both forms for CLE credit. The presentation and supplemental materials are available for download from your resources widget, and we will distribute these via email after the webinar. You don't have to take notes for the most part. Whereas previously no PowerPoint presentations were allowed at this program, preferring instead to have our presenters speak from their experiences this year because we know people need to look at something. So there are outline materials for each presenter and you will be given those. As I think about Leslie's panel and her co-panelists, there are a number of topics that will be discussed, GDPR in particular, that prompted me to study a little bit the philosophy of ambiguity. I think many of the laws we have to deal with are quite ambiguous, but to bring it down to everyday experiences, there truly is a philosophy of ambiguity, such as if you go into a bookstore and you ask a salesperson, where's the self-help section, have you more or less defeated the purpose? And what if there were no hypothetical questions? And lastly, so that this panel can get on, if a fly had no wings, would it be called a walk? And with that, Leslie, I will turn it over to you to talk about the ambiguities.
Excellent. Thanks so much, Steph. Just to run through the agenda, and I'd like to introduce our wonderful panelists we have with us. I apologize in advance for what will be probably a series of sports-related references, but I think ultimately in this COVID environment, I'm missing my sports events, so here it goes. Starting lineup, GDPR with Chris Chapman and Oliver Yaros. They're both partners out of our London office. Chris is in our financial services and litigation practices, and Oliver is in our cybersecurity and data privacy practice. Then we're going to turn and round the base, going with Jeff Taft, a partner in our DC office. He, among other practices, focuses on cybersecurity and data privacy. He's going to cover U.S. privacy and cybersecurity matters. Then we have Paul in the lineup, Paul Forrester, a partner out of our Chicago office. This description doesn't do him justice, but he is in our finance practice. He's going to talk a little bit about ESG, and then rounding for home, LIBOR. So without further ado, let's turn it over to Chris and Oliver. And I think really what would be helpful to start with, I think it's just an overview or a reminder of what GDPR is and what it requires.
Thank you, and hello everyone. This is Oliver Yaros, and as was just mentioned, I'm a partner in Mayer Brown's London office, and I'll be discussing this with Chris Chapman, also partner in the London office of Mayer Brown. The GDPR is important because it covers how organizations can use personal data, that's information about individuals, in the UK and in Europe. And it is a law that applies to both organizations that are based in Europe or the UK, but also organizations that are based outside of the UK and Europe, such as in the US, but are offering goods or services or products to people in Europe, or might be monitoring them in some way. And it comes up in the context of investment advisors because information is often sought by the authorities and third parties about individuals that may be in Europe and in the UK. And quite often there are questions about how information can be used and disclosed cross-border. So that's why it comes up. It's an important law, and it really covers any sort of information that can be used to identify living individuals. So names, addresses, email addresses that include people's names, employee reference codes, dates of birth, social security numbers, direct dials, all of that sort of information could be classed as personal data under European data protection law. There are some very high fines that can be issued for failing to comply with the GDPR in Europe. Each European country has its own data protection authority, and they can issue fines of up to 4% of an organisation's worldwide turnover. And there have been a number of fines in the tens of millions of dollars, and now the authorities are looking to issue fines in the hundreds of millions of dollars value. So that is why compliance with the GDPR is so important. When does the GDPR have to be addressed? Well, organizations have two roles under the GDPR. Either they're making decisions about how they use the data, that's controllers, or they're being told what to do with it, that's processors. Any type of activity with personal data is covered, so collecting, storing, disclosing, deleting. And when you, and the GDPR imposes a number of obligations, one of which is to tell people how their data is being used, that is, treating people fairly and providing them with information about how their data is being used. And there are also a number of internal requirements. But one of the most important requirements for the purposes of this conversation is you've got to have a legal basis for using data. And that's important when you're dealing with requests from authorities that ask you to disclose this type of information. You've got to identify a legal basis for using the information, and that might be that you get the consent of the individual, or you need to use it to comply with a legal obligation, or it's in your legitimate interests. And where the authority is outside Europe, you need a basis for disclosing it out of Europe to the foreign jurisdiction. And that is often a difficult hurdle to come across, because Europe and the UK identify some countries that are adequate and there are no further steps that are needed, but the US and other locations are not determined to be adequate, and that's when you need to find another basis to send data outside of the jurisdiction. And typically, where you're dealing with third parties, there might be mechanisms you can use, such as standard contractual clauses or other mechanisms. But frequently, when you're dealing with the likes of the SEC or other authorities, you're not going to be able to rely on those. You're going to have to be thinking about whether you can rely on consent or whether there is some other derogation you can rely on, like it is necessary for you to disclose this information to establish, exercise, or defend legal claims. And that's where you get into a consideration about what laws might require you to disclose this information. So that's a brief outline.
That's really helpful, Oliver. I appreciate that. Steph, we've had recently some experiences in various scenarios with investment advisors that are trying to register with the SEC, and we've also had various questions arise with respect to advisors who are already registered but maybe presented with GDPR compliance challenges. Do you want to talk a little bit about those scenarios, and then we can see what Chris and Oliver think?
Sure. Our recent experiences, and I would say we got a sense that the SEC was heading in this direction and headed it off at the pass, but from colleagues and others in our industry have heard some rather frightening tales associated with non-U.S. domiciled investment advisors trying to register as investment advisors under the Advisors Act. Stories such as the staff not accepting that filing, the Form ADV, and not making it effective unless an opinion of counsel by a, quote, reputable firm can deliver an unqualified opinion that the SEC would, notwithstanding GDPR, have access to all the books and records, including personal securities reports and the like, and as we all know, during bad exams, access to emails without an unqualified opinion. And the staff seems to be digging their heels in on that, which of course is a very difficult thing to deliver to the staff. We've heard stories about the staff asking for home addresses of non-U.S. employees that are actively engaged in the advisory business, which I think is the staff's attempt to test whether or not GDPR would be an obstacle. I had never in my years heard of the SEC asking for individuals' home addresses. Things like that have more or less forced us to express caution for a non-U.S. domiciled advisor that does not have a principal office or place of business in the United States. That's a defined term of an executive office from which the firm's officers, partners, and managers direct, control, and coordinate the activities. So a bona fide U.S. presence, unless that is established, it seems like the notion of a non-U.S. domiciled advisor registering with the SEC is fraught with peril. Do you agree with that, Oliver and Chris?
Yes, we do, Steph. It's Chris here. You can tell it's me because I sound quite different from Oliver. We do, and we thought what we might do is talk about that scenario because it's quite a good way to illustrate some of the different compliance issues that cross-border firms who are operating cross-border between the EU and US might experience. And at the heart of it all, really, is what Ollie was talking about the controls on data export out of the EU into the US. That's quite heavily controlled and gives rise to quite a lot of issues, and it is quite hard to give an unqualified opinion, but there are ways to manage it. So we were going to start mainly by talking about some issues, and then at the end we're going to come around to a bit of a more positive place as to how to manage these things. But we just wanted to talk through some of that as a way of bringing out some of the compliance problems that can arise. And we were going to start with consent, which I think Ollie mentioned is one way to get around some GDPR prohibitions. And I think both me and Ollie have been in situations where this has been suggested to us as a solution to the export problem. And I think we have our doubts about that. Sometimes, of course, where you've got a very large firm, it can be just quite logistically difficult to get employee consent. But Ollie, I wanted to just get your thoughts on a smaller example. Let's take the hypothetical example of quite a small investment advisor. Let's say they're based in the UK and they want to become SEC registered, and they're being asked to provide an unqualified opinion. Are they going to be able to do that if, say, for example, they get all of their staff to understand that they need, in order to get registered, the staff consent to allow them to export data to the SEC? What's your views on whether that is a solution to this export problem?
Thanks, Chris. It is a solution, but it does involve taking some risk. As you say, it is difficult to give an unqualified opinion. The difficulty with consent is that it needs, under the GDPR, to be fully informed and freely given and capable of being withdrawn. And without knowing what information is going to be asked for, it's difficult to establish it is fully informed. And, you know, in a employer-employee context, sometimes it is also hard to show that it is freely given. Having said that, if you've got a small group of individuals and you are able to have, you know, a good conversation with them, then that is a route that you might try and go down. But as I say, it does involve taking a bit of risk in that there is a danger it might be challenged by individuals later on.
Do you just want to expand on that a bit more, Ollie? What will happen? How might an individual challenge it, and what might that lead to?
Yes. So it's not a likely situation. It's probably a reasonably low-risk situation, but sometimes GDPR disputes often come up in the context of an employment dispute, where perhaps later on a person who is an employee who is disgruntled may decide that in the context of an employee dispute, they're going to raise a complaint to the Information Commissioner, which is the UK Data Protection Authority, about the fact that their consent was sought and was extracted in a way that wasn't valid. And of course, then there is a risk the Information Commissioner might investigate and potentially impose a fine for failure to comply with data protection law there.
I was going to raise it. Oh, sorry.
Well, I was just going to throw in, wouldn't life have been easier if GDPR allowed for an exemption to the extent required by applicable law?
Yes, we're going to get on to something that doesn't quite either. You're right, that would have been quite helpful. There is something similar that we're going to get on to towards the end, because that's quite an important characteristic. But Just sticking with consent, because it is sometimes raised as a possible issue. There's one other big problem with it, which I think Ollie alluded to. It's impossible to predict in advance what sort of information the SEC or another law enforcement agency might request. And the problem is a whole lot of information all firms will hold will include personal data which belongs to third parties. You know, even if that is emails with family members, often it's a lot more than that. Often it's emails with business contacts. You know, you can't get consent from those for those people. So consent simply isn't a solution to the scenario we're talking about, where the SEC wants an unqualified opinion. It's not a solution because you won't be able to get consent from all of the various third parties that the SEC might want information about in the future. So what are some other solutions? Another solution that's sometimes discussed, Ollie, is redaction. You know, you could redact personal data, and I think that also leads us into a discussion about what's the SEC going to ask for. And I think sometimes SEC and law enforcement agencies have in their minds that their requests will be quite reasonable and small, at least in if you're in a non-investigative scenario. So they might have in their minds that they might want trading records or transaction records or small amounts of data. And if that's what you're being asked for, it may actually be quite easy to redact personal information from it. But we've seen some much larger exercises, especially when investigations start, you know, requests for very wide-ranging selections of emails, sometimes millions of emails. Is redaction a solution there, Ollie?
I think it's a difficult balance. Obviously, you know, while something might be technically possible, it might not be, you know, appropriate for you to do that from a cost-benefit point of view. And of course, that may not be something that will be acceptable to the SEC. So I think it is a difficult balance, and you have to the extent you can, try and work with your contact there to work out what sort of search terms, for example, might be used alternatively to get down to the level of information that actually the authorities would like to see.
Yeah, I think that's the answer. That's certainly what I've found. I mean, redaction is a problem for two reasons. Number one, often the personal information is exactly what the SEC wants. So if the SEC's asked for, you know, 1 million emails, they're not going to want to receive those with all of the email addresses and names redacted. And the second problem is that is just a hugely expensive exercise. I mean, to redact personal information from 1 million emails will cost millions and millions of dollars. So redaction is not a solution as well. Where does that leave us, Ollie? How do we get this stuff from the EU to the UK?
Yeah, well, I think the important thing is to look at what legal conditions you could rely on other than consent to provide this information. And as I said, consent is one of those grounds, but it isn't the only one. So you need to have a ground for actually using the information, and it may well be that you are under a legal compulsion in the US to disclose this information, which could be enforceable as a matter of UK European law, depending on what the authorities here say, or what other mechanisms could be used to enforce that here. That is one route, but another way would be to look at whether you could establish it is in the legitimate interests of your business to disclose that information, and whether you could confirm that it is necessary to establish or defend your legal rights to disclose the information. And again, in that exercise, you would need to work out what information is proportionate for you to disclose. But that might be another way of going about providing the SEC with the information that they require.
Excellent. So, yes. So I we're there's so many things to talk about in GDPR and the manner in which registered advisors could try to navigate. But in terms of some just a brief closing takeaways, Chris and Oliver, what are your thoughts? And then we'll turn to U.S. privacy and cybersecurity.
Yeah, just to quickly wrap up, look, there is a solution here. Sometimes it requires a discussion with the SEC. The reality is firms can get the SEC the information the SEC needs. So the gateway Ollie mentioned for establishing or defending legal rights will usually work when the SEC needs information. It may not work when they're just asking for names and addresses to experiment to see if that will work, but if you have a discussion with them, you can explain to them that gateway should be suitable for the genuine purposes. As Ollie mentioned, that's not the end of it. You still will need to carry out a proportionate exercise to review the data and try and remove irrelevant information. But that can usually be managed with the SEC through discussions with the SEC by understanding what they need and what they don't want, by agreeing searches with them if you need to. All of that actually should work. As a very last resort, there's the legal compulsion solution. I mean, I think Ollie mentioned that requires legal compulsion under EU law, so it's not enough for the SEC to require a US branch of a firm to provide information. But what it can do instead is use memorandums of understanding with and arrangements with EU regulators to get them to request the information, which will be sufficient, and are now quite sophisticated at doing that. And so in terms of a solution to the can I give an unqualified opinion, the answer is unqualified is a bit difficult, but you can usually have, there are ways to have discussions with the SEC to satisfy them that they can get whatever they need. In terms of, other takeaways about the GDPR more generally, I think the key points are, look, it is really quite wide and long in its reach. So it's really important to think about it, even if you are not based in the EU. The other is that when you are asked to provide information by regulators or law enforcement agencies, you need to think quite carefully about GDPR issues. And the final thing is that even when it seems, as sometimes it can, that regulators are being unreasonable, there, in our experience, is usually a route through to discuss this with them, because the GDPR is not actually some awful thing that will always prevent them from getting what they need. There are always ways around that. Of course, you can deal with different sorts of staff. Some of them don't understand the GDPR and won't understand why they can't get an unqualified opinion, and will need that explained to them. But other times, they actually know quite a lot about this area. I have certainly worked on cases where the US law enforcement agencies I've been dealing with have known more about the rules applying to export under the GDPR than their counterparts in the UK. So it is a topic they're reasonably familiar with, and the key is just to get into a situation where you can talk to them and discuss with them how you can get them what they need. Those were my wrap-up points.
Great. Thank you so much, Chris and Oliver. So turning to U.S. privacy and cybersecurity with Jeff Taft. Jeff, are there similar issues that arise under U.S. privacy laws?
I think you certainly have similar issues, obviously, under U.S. privacy laws. I mean, I think the interesting thing about GDPR from my perspective and from a lot of clients' perspective is it's having an influence on the privacy debate in the U.S. and, helping kind of shape some of the next generation privacy legislation we're seeing both at the state level and being considered at the federal level. So I think there's going to be, heightened concerns around privacy issues in the U.S., very similar to what you're seeing with GDPR, in the future. I think cyber and privacy obviously are two huge issues for investment advisors and others in the financial services business. And I think that's why this is probably the third or fourth year, I think, that we've had these topics on the agenda at the IMU. And I think that while they remain on the agenda, I think the focus changes each year. When I look at cybersecurity, again, it's been on the OC exam priorities list now for 4 or 5 years in a row. We've discussed it at IMU for that exact reason. But it's not the same thing each year. And I think what makes being a cybersecurity practitioner interesting and what makes it very vexing for clients is that the threats and the technology are constantly changing, and it changes the whole dynamic of compliance and protecting yourself. So I think that's very important. I think when OC looks at cybersecurity, they're focusing on, a few particular areas: governance, risk management, access controls, loss prevention, vendor risk management, training, and then incident response. I think those are the broad areas that they look at. I think when you drill down on those areas, though, you're seeing some kind of interesting developments, and really we can't kind of highlight all of them in this brief time, but I did want to kind of pick up a couple of them. When you go and look at the OC cybersecurity resiliency observations from earlier this year, and granted it's pre-COVID, so it may not necessarily reflect the concerns right now, but I do think that these are, relevant concerns. I look at risk management and risk assessment being very important. Quite frankly, for most companies, their risk assessment probably changed dramatically when they moved to remote operations. But I'm not sure how many companies actually went out and did a new risk assessment to kind of assess those new risks. So that's one area I think that's been popping up. Access controls and rights are very important. This is how employees and others access data that you may be maintaining. It's very important to have access controls, but I also think it's very important that you review those controls. When people change jobs, you need to change their access controls. When people depart the company, you obviously have to remove them. I think in a COVID environment, it's not always clear to me that departures are being communicated in the same manner they would be if everybody was working in the same office. People wouldn't see Fred anymore and they would say, "Is Fred gone?" And everybody would be like, "Yeah, Fred's gone." But in a remote environment, it may not be quite as clear. So I think that's important that, you kind of take a look at some of these things. Two key observations and takeaways that also kind of put out there is, one, vendor risk management. One of the key issues in cybersecurity, definitely probably one of the weakest link, I think, for clients, and one of the issues that they're all wrestling with. Clients don't care how the breach happened. They just care that it happened. So blaming on the vendor doesn't really get you very far in the client's eyes. The second thing I would mention, too, is training. It's something that's within your controls. You may not be able to stop some foreign nationals from hacking into your system, but you can certainly train your employees not to click on phishing links. And quite frankly, that's a bigger risk for most people. So that's something to kind of keep in mind.
Thanks, Jeff. So what's happening with the work from home environment? How's that changed the landscape?
Well, I think it's certainly increased the risks that we're seeing, Leslie. And the risks have increased for a couple of reasons. One, there's more remote access to networks. So that's giving additional access points for bad guys. I think you're seeing more people using personal computers and their own handheld devices. So that means that the family computer, which may or may not have viruses on it because of other people's use, may compromise people's work environment. So that's another thing to kind of keep in mind. I also think that controls over records and information, also in an environment that we're in right now, are less stringent. People may have the ability to print out client information at home. They may have the ability to access client information on their home computers, so it may not be as secure. So I think that's certainly something we're seeing in this COVID environment, and that's something that OC's COVID Risk Alert, really focuses on. So I think that's an important, thing to be thinking about. The client issues that we're seeing, I think, in the COVID environment are increased cyber attacks, more ransomware, more phishing emails, and service provider vendor issues are coming up a lot more. None of these are insurmountable, but they're things that you need to pay attention to. And one thing that we don't think enough people are doing is we don't think enough people are doing, tabletop exercises and other types of, security drills in this remote operations environment. Those historically have been done in the environment where, people have all been in the office together, and it's much easier to do business continuity or a tabletop exercise when everybody's sitting in the same office. But it's important that people be doing those things in this remote environment and reflecting what goes on in a remote environment and how people will communicate.
Very helpful, very helpful. So, Jeff, share with us your thoughts on the evolving privacy landscape and your outlook for privacy in the U.S.
Yeah, I think the privacy landscape is evolving, and part of it is just it's a maturation that we would see. GDPR obviously is one, thing that people look at and they say, why don't we have a privacy law like that? I think the average U.S. consumer is much more privacy focused and much more interested in privacy now than they've ever been. There have been all sorts of stories about how their data is being used. So I think we're seeing what was a sectoral approach. In the financial services sector, we have GLBA and we have HIPAA in the healthcare sector and others. I think we're seeing at the federal level there's being some focus on whether there should be some sort of comprehensive privacy law, like a GDPR, in the U.S. Congress has been debating, amongst other things this year, some privacy legislation. I think because of COVID, obviously nothing's really going to get done this year, but I would expect it to be a topic that gets picked up next year. Privacy and cybersecurity are really topics to me that in some ways are bipartisan. I think everybody's in favor of cybersecurity, and I think that everybody's in favor of protecting people's information. While they may not agree on exactly how to do it, I do think the topic itself is somewhat of a bipartisan topic. So we could see some movement at the federal level. Oftentimes when we don't see movement at the federal level, we see the states obviously jumping in to fill the gap. And I think that's something that's important. That's something that's obviously going on right now. California with the CCPA is something that jumps to everybody's mind. CCPA is now effective and it's being enforced as of July 1, 2020. For folks on the phone, brokers and dealers and investment advisors who are subject to GLBA, there's an exception in CCPA for data that's collected, processed, sold, or disclosed pursuant to the GLBA Act. But that doesn't necessarily mean that all of your data is going to be outside of the scope of CCPA. So obviously you have to take a real careful look at that. So that's an important aspect, I think, for people to be looking at, even if you have a GLBA exception to CCPA. I think we're seeing other states start to look at CCPA-like laws and enhanced privacy and data security laws. Again, I think COVID has basically brought a lot of that legislation we thought would occur this year kind of to a halt at the state level. States have been focusing on kind of the more important issues dealing with COVID and some of those issues. But even California, is moving to kind of reinforce and re-enhance its own privacy law, and there's a ballot initiative in November that would have the effect of replacing CCPA, which has only been effective really since the beginning of this year. So that's something to obviously watch in California, and I think that's something that will again be picked up in other jurisdictions.
Thanks, Jeff. So if you had to summarize some key takeaways for registered advisors relative to cyber and U.S. privacy, what would they be?
Yeah, and I think some of these relate to the COVID remote operations environment, but I think some of them are a little broader than that. But let me start with kind of revisiting your cybersecurity policies and procedures in this work-from-home environment. Again, I think you have to consider remote operations and look at your policies to see, quite frankly, whether they address how you're operating in a remote environment. And again, you have to test those policies, and I think that includes doing remote tabletop exercises and other types of things to test how resilient you would be in a remote environment as opposed to everybody working in the office together. I also think that you have to impose some additional controls, and those additional controls can be in the form of training. Training can be done effectively from a remote perspective. I think a lot of the training is online. I think that training has to redouble some of the efforts in this space around phishing and malware and things of that nature. Those remain the biggest threats, I think, to most clients, is that their employees are clicking on links or doing things that are compromising their system. Right. Third, I would say, vendor risk management. The onboarding and oversight procedures for vendors are extremely important. It doesn't matter how strong your cybersecurity procedures are. If you have a vendor that's playing fast and loose, or a vendor that's willy-nilly with security, that's going to compromise your whole system. So I think you have to be careful there. And the final thing I would say is I think you need to develop a scalable approach for addressing, the new state privacy regimes and cyber requirements that are coming up. I think clients are finding it extremely difficult to constantly be revising their vendor agreements. Every time a new privacy law comes up, it was GDPR, now it's CCPA. I think both the clients and, quite frankly, the vendors are getting tired of constantly doing that. So I think people have to think a little bit more holistically about what kind of changes they can get in their agreements and what's a better way to kind of go about updating them to reflect changes in law. So at a high level, Leslie, I think those are some of the key takeaways. I don't know if there are any other points, that might come up or things you might want to consider.
Yeah, that's really, really helpful, Jeff. Thank you. I think that makes sense. And certainly the oversight of service providers is something that we're seeing the SEC continue its interest in, particularly when they're affiliated. So thank you. So let me pause for 1 second and read the all-important and ever-popular CLE code. It's 20 ESG 0909. Include the code on your affirmation form, and then both the affirmation form and the evaluation form are can be found in the resources widget on your screen. Thanks again, Jeff. Without further ado, let's turn to ESG matters, and none other than Paul Forrester. Paul, please take it away.
Leslie, thank you very much, and good morning, good afternoon, good evening to our audience, depending, of course, on where you are. I'm talking about two matters, ESG and LIBOR, which I'll get to in a second. Both ESG and LIBOR are key issues at Mayer Brown. So if you're familiar with mayerbrown.com, you would find our relevant resources available under the Key Issues tab. And these are a slight change of pace from the prior discussion, although the prior discussion certainly links into some of the points I'm going to make about both ESG and LIBOR. But first, I'd like to introduce ESG at Mayer Brown. We have an ESG group. It has a dedicated webpage. We regularly produce perspectives, which we think our clients and many of you may be familiar with and certainly of interest to you. We host ESG events, and we produce a quarterly snapshot, which is intended to be a global summary of ESG developments that we think, of course, will be of interest. I would also like to note that ESG, which has existed for about 2 years at Mayer Brown in an organized form and includes well over 50 lawyers taken literally from every office and practice area of the firm, sprang from our own ESG commitments, including the green committees, which the firm has in each of its significant offices, and a firm-wide green committee, which I'm pleased to chair. And we've implemented a lot of green initiatives across the firm for our own purposes and devices. And again, I think that just reflects everybody's experience with ESG. But one thing of interest to me, at least, is the degree of specialization across our ESG group is quite good. And for example, two illustrations. One, we have an Asia private equity focus coming out of our Asian offices, which is very interesting. And then, frankly, more globally, we have a supply chain initiative as more and more of our corporate clients are talking about greening their supply chain, certainly post-COVID, to better manage their resources. Well, let's talk about you. Obviously, ESG AUM is huge. It's currently around $30 trillion, and its progress is remarkable. ESG as a term of art didn't exist before 2004, where the term was used in a United Nations report. So it's about 10 years old, and in that time, of course, we've learned a lot about it. And again, it's certainly become a significant event. It's rarely a day goes by without there's not some important ESG development. Those of you who are focused on ESG would be aware that it was originally taken up as an exclusionary screen for equity investment strategies. Increasingly, of course, ESG is now employed across all asset classes and has moved from a mere exclusion or screening tool to something that's become quite integrated in investment decision-making processes that managers are using. There's no doubt that ESG funds are extraordinarily popular, and ESG fundraising and rebranding is accelerating at a truly striking rate. Just to give you one very small example, sustainable high-yield corporate and municipal funds in 2019 were about $1.7 billion. A couple of months ago, they hit $45 billion. So just the rate of growth across some of the asset classes that are reflective of ESG strategies is really striking. However, there are some important things to note. One is there's no standard definition of what ESG actually is. And while I think there's broad consensus about environmental, which is the E, there's far less consensus and certainty about social and governance factors. I also think it's fair and important to note that we are starting to see significant attempts to cure that problem. And I would note in particular the EU has a very organized effort to come up with a taxonomy for ESG, which would impose a lot more rigor and discipline, although they would immediately and have noted that the fact is the minute you do it, it's outdated. And so you have to have really a continuous process to come up with taxonomies for ESG investment strategies. The second issue that's important for asset managers, there's no standardized data, and many strategies rely on third-party providers. It's in many cases quite unclear what they're telling you when they provide that data to you. They obviously are also under pressure to continue to evolve and improve their methodologies and the way they evaluate ESG factors. And do so. But again, there's no standardization of the data, and so it's very time dependent. And then last but not least, it's not clear at all that there's any standard use or application of even common data. Where you do have common data, companies can use it, managers could use it differently, conclude different things from it. And so again, there's significant variation in what actually happens once you have even standard ESG data. These obviously challenge all of you as you think about issues like disclosure and certainly other risk mitigation matters. One important stimulus for the interest in ESG, particularly in the fixed income area, is the rise of green finance. Green finance is now around $400 billion, is growing year over year at an extraordinary rate. Quite interestingly, since COVID-19, what was a predominantly green bond or loan type market has really developed, and we've seen a substantial uptick in social and sustainable issuance. The people that manage the related green bond loan principles and their corollaries for social bond and loan principles and sustainable bond and loan principles continue again to update them, and importantly, they seek to mitigate challenges or claims of greenwashing. And the most recent updates were made in June this year at the annual meeting of the International Capital Markets Association. They really reflect some quite good work that's being done by the groups that are producing the principles, and in particular, recognizing the challenges of defining and describing and proscribing sustainable activities. There's a very thoughtful paper that was taken up and approved in June this year to really put some very good detail and analysis behind what is or is not sustainable and whether you could count something as sustainable or not. However, it's true, I think, to acknowledge that, again, that poses, more change, more requirements for updating, more requirements for revisions of disclosure as, again, those principles in which describe the sort of investments you may be managing continue to change and evolve. One slight puzzle in all of this is the fact that most of it is not motivated by greed. In fact, the greenium, which is a premium for a security being green, is not showing up. A number of studies have evaluated the market, and they've been unable to point to a significant greenium available to issuers or borrowers. Having said that, issuers and borrowers don't seem to care, investors don't seem to care, and so the market continues to grow. One important space to watch is the fact that the principles are quite broad in their permissible descriptions of what does or does not constitute an eligible green or social or sustainable bond or loan, and that it's certainly possible for the market to evolve and become much more specific about what is or is not an appropriate use of proceeds. And that's relevant to managers because, for example, you may have a particular strategy. Your strategy may explicitly exclude coal and coal-related. Well, guess what? China has just decided that they're going to count a lot of clean coal as green. Does that mean you could buy one of those green bonds or not? Another controversial area, of course, is biofuels, and because of the land use impact of biofuel production, not everybody thinks that's a good thing. So you've got to be, or at least the possibility is, the market will become much more discriminating about what they're going to permit issuers and borrowers to do with the green finance. That is likely to be first seen in the EU again, where they have a green plan and a green finance strategy, of which the taxonomy is an important component. But it's going to drive and dictate a lot of very specific activity, which again, they're highlighting as a potential way to enhance the recovery post-COVID. But again, that taxonomy is going to become much more prescriptive and definitive and specific. And again, that raises continuing issues for asset managers as they seek to tell their clients what, in fact, their strategy is, what you will or won't do as part of the strategy, and then you try and manage your strategy and make sure that what you're doing, what you said you would do, and then you're not running afoul of some undisclosed change. All of this is happening in, of course, an active regulatory world. The SEC in particular for U.S. managers has been quite vocal about wanting to know about ESG activity. They've noted the rise and uptick in ESG funds. They're obviously concerned that not all ESG funds are in fact appropriate, and so they announced earlier this year that ESG is an examination focus and a priority for 2020. We summarized that announcement in a legal update, which is linked in our materials. But this is obviously just reflective of several years of significant interest in SEC examinations about ESG. And all of that would suggest the SEC has a continuing interest in the type of scoring and benchmarks that are being used in these strategies, particularly where you're relying on a third-party vendor or system for data, and certainly they're looking for your related written procedures. They ask about, in detail about the list of investments that you've made and how you scored them. And certainly they want to see internal processes and policies which really go to the compliance questions, which I have highlighted before. And last but not least, they're very interested in the pecuniary aspects, which includes obviously the returns that you obtained on your ESG investments, as well as the metrics and other analysis that you do in respect of them. And last but by no means least, as I mentioned, they're very focused on the marketing materials that have been used to raise ESG money. Not alone, because the Department of Labor wants to curb ERISA investment in ESG. The Department of Labor wants to restrict ESG. The guidance, actually, that's a mistake. It was issued in June of this year. The Department of Labor proposed that basically fiduciaries for ERISA money couldn't use ESG without restriction, and in fact, they only were allowed to use them when they were non-pecuniary distinguishing factors. That is very consistent with several years of DOL guidance on this question. They've been very concerned that you can't abandon the requirement that you produce returns for retirement funds and call yourself green. You have to only do green when you can show that it's no less favorable than a non-green investment is for the ERISA money. The proposed guidance, however, because it was relatively specific, has attracted a lot of attention and controversy. And in fact, the asset management industry, as many of you may be familiar, is pushing back quite hard on this proposal. And they're suggesting that once you integrate ESG into your investment function, you really can't back it out and decide that ESG can only be used as a marginal consideration. If you really think your fiduciary obligations are best served by including ESG analysis, you should be allowed to do so without regard to whether it's pecuniary or non-pecuniary, which is a pretty cogent view. In any event, that's playing out, and we'll just have to wait and see how that ultimately ultimately comes out. So what does that mean to you? I think I'd highlight the risks, as I probably have already inferred, is issues of misrepresentation, reputation. Again, it's just a challenge to disclose what your strategies are and what you're going to be doing in an environment where there is no defined standard and the standards that are emerging are evolving. There's just not much you can do about that other than to be attentive to it and to pay particular regard to the changes and have in place processes and systems that really allow you to track it. There's no doubt, again, that there is an increased and heightened regulatory scrutiny and activity in this area. A couple of things here. The SEC produced a request for comment on its names rule earlier this year, asking about whether they should use that rule to curb folks calling their funds ESG when they may not otherwise be. We summarized that in a related legal update, which is linked here. The SEC remains conflicted about mandating disclosure of ESG. The history here, for those of you who are interested, is in 2016 when they last took up Regulation SK in when they previously took up Regulation SK in some detail and wanted to really dig into risk factors, they literally received thousands of comment letters that said, we can't find out enough, their companies aren't being forthcoming, and they're not disclosing material environmental, social, and governance risks. The SEC, as you know, was unmoved by that, although they've certainly continued since then to face significant investor pressure. Most recently, an investment advisory committee said the SEC really should take ESG mandatory disclosure. There's certainly a petition from 2019 which asked the SEC to take it up, arguing that it was clearly material and to not do it was really misleading. That petition languishes. It's unclear whether it'll ever be acted on. And certainly in most recent statements in connection with the recent update for Regulation SK, it's quite clear commissioners, and including the chair, remain quite conflicted about mandating disclosure in the area in ESG, in part because they're concerned that the minute you mandate it, it's outdated. The minute you start prescribing it, you start directing capital in a particular way, which they're anxious not to do. And they continue to argue that their general disclosure requirements for material information would suggest that companies ought to be telling you when, in fact, they have material ESG risks. That's starting to become more true. There's no question that corporate disclosure of these matters is improving and is getting more replete. And candidly, after the most recent revisions to Regulation SK, we should know a lot more about human capital, for example, than we knew before that revision. Just the last point here, I want to note the EU has moved quite quickly on this. They have a very significant EU Green Deal, which has been approved. It's being implemented. Part of that implementation is green finance, and that's thought to be an important stimulus for recovery post-COVID. And a significant component of the Green Finance Initiative is the EU taxonomy, which has got a very detailed and technically proficient sort of approach. They formed a technical advisory committee, and they've been producing quite thoughtful papers about it. One of the significant events is, though, that it doesn't really travel beyond the EU. A lot of the stuff doesn't mean the same thing here that it means there, and it's very unclear whether it will ultimately be helpful as the U.S. or any other jurisdiction takes up some of these questions. Importantly, not everyone agrees with the EU taxonomy. So, for example, some of the vendors, MSCI, which is a prominent one in Sustainalytics, have said, we're not going to necessarily conform our EU criteria to the EU taxonomy. We think our ESG criteria is right, and it may or may not be the same. So you could wind up with just, unfortunately, another set of data, another set of scoring that you'll have to evaluate and decide whether that's included in your compliance requirements or not. So that's it. That's it for ESG.
Yep. So let's turn to LIBOR and round for home with that.
Okay. Well, unless you've been asleep, you're aware that LIBOR is going away in December of 2021. And looking at it today, it's probably not going to be pretty. Again, to briefly introduce LIBOR Transition at Mayer Brown. LIBOR Transition at Mayer Brown has a formal group, well over 100 lawyers at this point from every office, every practice area of the firm. Linked here is our transition portal, our transition task force, again, 100 lawyers plus. We're producing weekly or bi-weekly transition digests, which are intended to be global summaries of relevant IBOR transition events. And last but not least, we are shortly to announce an ION IBOR transition blog, which again will provide almost real-time or near real-time updates to the market as to related IBOR developments. The reality is we're not quite as far along as we thought. The statement that initiated the search for replacements for LIBOR in 2015 by the Financial Conduct Authority really started this process, but we burned the period that they created when they said we're not going to compel banks to quote LIBOR after December 2021. We've burned 3 years of that 5-year period chasing risk-free rates across the world. And risk-free rates probably work for a lot of the markets, but they don't work for all of the markets, as I'm going to talk about in a second. Just a quick primer on LIBOR. Obviously, it was developed as an objective proxy for bank funding costs in the late 70s, early 80s, when skeptical borrowers weren't comfortable with prime anymore as a result of prime rate scandals which had emerged. Quite striking is that beyond that very humble start, it's grown to be the benchmark for well over $300 trillion of swaps, securities, loans, mortgages, and consumer products. It is, I think, not inaccurately referred to as the most important number in the world. The good news is about 90% of global LIBOR exposure is interest rate swaps. And obviously, the benefit of that is that ISDA can produce a protocol as it plans to, and the protocol, if adhered to by enough folks, is going to really resolve a very significant amount of that LIBOR exposure. But there's still about $30 trillion of cash products. So you've got floating rate bonds and loans and mortgages, all of which are currently benchmarked to LIBOR, for which you need to find a replacement. What went wrong? Well, I think it's really unintended consequence. What happened is we started to reform bank capital rules in the early 2000s, and one of the consequences of the change in the bank capital rules was a reduction in interbank term borrowing. And so literally the market that underpinned LIBOR went away. What actually happened is it fell to really low levels and was regarded quite properly as an inappropriate benchmark for $300 trillion of exposure. Obviously, around the same time, certainly past the great financial crisis, we saw evidence of manipulation of the rate because, again, it was in very small numbers and people were quoting, not actually basing it on actual transactions. And so there was a significant impetus then to find risk-free rates. Global financial regulators decided that it had become inappropriate. They then started to hunt the world for liquid, transparent, overnight markets for so-called risk-free rates. Unfortunately, risk-free rates are secured and overnight. LIBOR is unsecured and term. So you've got to make some significant adjustments to risk-free rates to get them to be comparable to LIBOR. That has taken much more time and has proven to be much more difficult than I think anybody would have anticipated way back in 2017. Comparability is a pretty low standard. Embedded in that question, however, is whether the proposed adjusted risk-free rate is actually fit for purpose, and that's caused some significant delay. For example, the loan markets in the United States are likely in the large part to go to SOFR, but there's a significant component in the middle market, regional bank market, which may not. And they've been quite vocal about arguing that SOFR is irrelevant to them. They don't hold treasuries. They don't trade overnight treasuries. Their cost of funds has got nothing to do with those things. And so they're looking for a much more credit-sensitive alternative to LIBOR. That's currently reflected in something called the Credit Sensitivity Group, which is a group of banks and regulators that was convened by the Fed to start thinking about this. They are talking about alternatives like a Mirable, ICE Bank Yield, and a Bank CDS product from IHS Markit. And then most recently, something called Across the Curve, which would be extracted from trace data, which would be, at least it's argued, a more credit-sensitive spread adjustment to SOFR. That has to play out. The last of the planned credit sensitivity group meetings was only a week ago, and obviously there's some formal process that we'll have to follow before we find out what the comparable rate would be. What's going on and where are we now in the United States? We've got the Semi-Official Alternative Reference Rates Committee. Note that it was reference rates, although they only produced one, SOFR. They formed a PACE transition plan. They produced, as promised, a variety of product-specific fallback provisions, and as well as providing general best practice guidance to the market. The intent of all of that is to facilitate, again, a transition from LIBOR to SOFR and SOFR replacements by the December 31, 2021 deadline. The most recent best practices have started to put milestones and really put teeth into the discontinuance. Floating rate notes are meant to transition away from LIBOR by the end of this year, and asset-backed securitization and other products and loans are meant to move by June next year, and CLOs by September next year. But there are significant issues to complicate the transition, including if you have related hedging, you've got to coordinate the cash product with hedging. There's an emerging group of category of contracts called tough legacy contracts, which it's going to be, as a practical matter, unlikely that we'll be able to remediate them by those deadlines. And that's due primarily to the fact that they included required consents of note holders. In the United States, under the Trust Indenture Act, you can't impair a holder's right to receive interest unless that holder agrees. So in theory, you may have 100% approval requirements for a change of this type because you may or may not be impairing or affecting their right to receive interest. That's a significant challenge because nobody ever gets 100% note holders to do anything. And last but not least, and this is the point I wanted to tie to some of the earlier remarks, this transition is imposing already and is going to impose a significant strain on payment and compliance and reporting systems as well as related personnel. This is the time where we know SOFR is the replacement. We should be tabletopping exercises for SOFR. As Jeff noted in his remarks, it's much, much more difficult to do that in a work-from-home environment. And so the great fear is that what should be happening isn't, and we're burning time, and the deadline's coming, and the period to the deadline is getting shorter and shorter, and we're just not going to make it, which is why this may not be pretty. Just a couple of minutes on the tough legacy contract problem. Recognizing that it is a problem, there's some attempts to come up with legislative and regulatory solutions. In the U.S., the ARC has proposed a New York legislative solution, although we question the efficacy of that solution. Even if the New York State legislature could take it up, they seem to be distracted by COVID. In the UK, the government has actually promised a legislative fix. We've also covered that in an update. Unclear how and when we'll see that legislation, but certainly it's being promised. And the EU, they're working on some proposed revisions to the benchmark regulation, which may allow what's called or thought of as a synthetic LIBOR to remain in place and be available to this very limited class of tough legacy contracts. Again, we question whether you can have a synthetic LIBOR and limit it just to tough legacy contracts, but that's a question, much more detailed question for another day. And just as the case for ESG, SEC wants to know where you are. And so, again, in their risk alert for 2020, the OCIE said that LIBOR preparedness is an examination priority. We've spoken about both those things in an update and a webinar. We are certainly seeing an uptick in client interest and engagement on LIBOR transition matters and preparedness, and certainly some are calling as a result of SEC examinations. And my own view is, not being an expert like Leslie and Stephanie and some of the others in SEC examinations, is they understand what they're looking for, and they're asking very pointed questions about where you are in your transition preparedness. Are you thinking about forward curves? Are you thinking about valuing your investments using these new replacement rates? All of that is quite properly the focus of the SEC examination.
Yep,
so
agreed.
I've gone way over, and I apologize, but hopefully you'll find some of this valuable. So, Leslie, back to you for closing.
Great. Thanks, Paul. Really, really helpful. And yeah, so the LIBOR sweep is indeed underway. The sample document request attached to the risk alert looks quite different from the document requests that we've seen that have gone out to actual investment advisors and actual exams. They're much more pointed, much more detailed in real life. Thank you to all of our panelists. This has been terrific. Keep in mind, my takeaway from this is each of these subjects is riddled with tough questions, risk exposure to advisors in each area. We could spend an hour on each topic alone. So please, tread carefully. If you have questions, come to us.
Thanks. Thanks, everybody. Thanks to all the panelists. For those who checked in on the first panel, I tried to come up with a Scheherazade type setup to keep you coming back for more. On the first panel, I talked about how these Scrabble experts had gotten together, and their task was to take approximately 15 words or expressions, Scrabble them and scramble them up and come up with something relevant. So in the first panel, I told you that they took the word Presbyterian and they came out with best in prayer. They took the expression the eyes and they came up with they see. And lastly, for the first panel, they took George Bush and they came up with he bugs Gore. Again, each letter had to be used for a meaningful scramble. For this panel, and I have plenty for the others, they took the word astronomer and they came up with moon starer. They took the word the Morse code and came out rearranged to here come dots. And for those of you who have children going back to college, they took the word dormitory and came up with dirty room. So if you like those and want to hear more or have interest in our funds, what's going on in the fund world, and that's fund with a D, come back next Wednesday at noon for another session of Investment Management University. In the meantime, stay well. Take good care of yourselves and yours. Bye-bye.